Okay, let's unpack this. I want you to picture a scenario. It's 11 p.m. on a Tuesday. You're lying in bed, the lights are off, and the only thing illuminating the room is the blue light from your smartphone.
We've all been there.
We've all been there. And you've done the responsible thing, right? You've read the books, you've listened to the shows, and you bought a little bit of Bitcoin. You understand it's digital gold. You get the scarcity, and you're watching it move.
And it moves.
Slowly. It's moving so slowly, steadily. Maybe it's up 2% on the week. You feel smart. You feel prudent. You feel like a serious investor.
It's the safe, sensible entry point. You're essentially investing in the S&P 500 of the digital age. It's the bedrock.
Exactly. You are the Warren Buffett of your bedroom.
Yeah.
But then your thumb slips. You hit the top gainers tab on your tracking app. And suddenly, logic just leaves the room.
Oh.
You see it. Some coin you have never, ever heard of. Let's call it Rocket Moon. And it is up 400%. In a single week, 400%. And suddenly, that 2% gain on your Bitcoin doesn't feel prudent anymore. It feels boring.
Ah, yes. That is the moment the math of greed kicks in. It's a very specific, very dangerous psychological switch. It is the precise moment where investing turns into gambling.
It is. You start doing this mental gymnastics. You think, okay, look, if I had put $1,000 into Rocket Moon last week, I have $5,000 right now. I could pay off my credit card. I could fix the transmission on the car.
Right. The what-ifs start piling up.
But because I put it in Bitcoin, I have $1,020. And that leads to the most dangerous question in the entire industry. I think every listener has asked this at least once. Why am I buying this expensive orange coin for tens of thousands of dollars when I can buy millions of these cheap coins for fractions of a penny?
And that right there is the hook. That is the siren song of the altcoin market. And look, we have to be fair here right at the top. We aren't just going to sit here and bash everything that isn't Bitcoin.
No, not at all.
The world of altcoins, which is literally just alternative coins, anything that isn't Bitcoin, is a world of incredible innovation. I mean, we are talking about smart contracts that can replace legal agreements, decentralized finance that replaces banks, AI running on the blockchain. The technology is absolutely real.
I hear a very heavy but hanging in the air.
But it is also a world of absolute smoke and mirrors. It is the Wild West. For every project that is legitimately trying to rebuild the global financial system, there are dozens, maybe hundreds of founders just printing money out of thin air.
Right.
They're paying influencers 5 figures to hype it up and then dumping it on retail investors, people like you, before you even realize what happened.
So the core problem is crypto real? The problem is distinguishing the signal from the noise. How do you tell the difference between the next Ethereum, a world-changing technology, and the next BitConnect, which turned out to be a massive Ponzi scheme that wiped out life savings?
It comes down to one word. It's a concept that sounds dry, almost academic, but it is actually the most exciting part of this analysis because it's the weapon you use to defend your wallet. That word is tokenomics.
Tokenomics.
Token economics.
Correct. Think of it this way. When you go to the grocery store, you don't just throw things in your cart because the box is colorful or has a cool cartoon mascot on it, right?
Well, maybe if I'm hungry. But no, not usually.
Right. But if you're being careful, if you care about your health, you turn the box over. You look at the nutritional label. How much sugar? What are the ingredients? Is this actually food or is it just processed chemicals disguised as breakfast?
I love that metaphor. We are looking for the nutritional label of a cryptocurrency. Exactly. Today, we're going to teach you how to read that label. We aren't looking at the price chart. The price chart is the colorful mascot on the front of the box. We're looking at the supply, the distribution, and the value accrual. We're going to look under the hood to see if the engine is actually connected to the wheels.
So our mission today on this deep dive is to equip you with that specific skill set. We're going to categorize this zoo of 20,000 plus coins so you know what you're actually looking at.
Yep.
We're going to debunk the cheap coin fallacy that loses people so much money. And we're going to get into the nitty-gritty of inflation traps and who actually owns the coins from the start.
We're going to teach you how to spot a scam, how to value a hidden gem, and why market cap is infinitely more important than the price tag you see on the screen.
So let's jump into the jungle. We call this section the zoo because, frankly, it's wild out there. You mentioned there are over 20,000 cryptocurrencies. That number seems low, honestly.
It is low. I mean, new ones are minted every single minute. It is trivially easy to create a token now. You or I could create deep dive coin in about 10 minutes with absolutely no coding knowledge. It's wild.
And if I'm a newcomer, That is just paralyzing. It's a wall of noise. How do we even begin to sort through that mess?
You have to categorize them. This is where most people fail immediately. They treat Ethereum, Solana, and some random meme coin their nephew told them about as the same asset class.
Yeah, they just lump it all into crypto.
And that's a fatal error. They are trying to do completely different things. It's like comparing a share of Apple stock to a lottery ticket and a barrel of oil. They are all assets, sure, but they function in totally different ways. So we usually break them down into about 5 buckets.
Okay, let's go through the buckets. Bucket number 1. These are the heavy hitters.
Bucket 1 is smart contract platforms, often called layer 1s. This is probably the most important category to understand. Think of these as the operating systems of the crypto world.
The OS.
If Bitcoin is like a pocket calculator, it's very, very good at doing one thing, which is storing value securely. These layer 1s are like iOS or Windows or Android. They're platforms for other things to be built.
So they're the foundation. They're the empty lot that other skyscrapers are built on.
Precisely. Examples here are Ethereum, Solana, Cardano, Avalanche, the BNB chain. The value proposition here is really strong. Think about it. To use any application built on Windows, you generally need the Windows OS functioning. In crypto, this connection is financial.
How so?
To use any app on Ethereum, you have to pay a transaction fee. We call this gas. And you can't pay that fee in dollars. You must pay it in the native token, which is ETH.
So the token has a forced utility. If people want to use the apps, the games, the banks, the art markets, they're forced to buy and spend the token. There's no other way.
Exactly. It creates a baseline of demand. The more apps built on the OS, the more demand for the token. This is generally considered the most valuable category because it captures the value of the entire ecosystem.
It's like the landlord model.
It is the landlord model. If a popular game launches on Ethereum, Ethereum wins. If a popular bank launches on Ethereum, Ethereum wins. All roads lead back to the base layer.
Okay, that makes sense. Operating systems.
Yeah.
But we know Ethereum has issues. It's slow sometimes. It can be super expensive. I tried to buy an NFT once during a hype cycle, and the gas fee was like $50.
Oh.
That brings us to bucket number 2.
It does. And bucket 2 deals with that specific problem.
Yeah.
Because layer 1s like Ethereum prioritize security and decentralization above all else, they can get clogged. It's like a single-lane highway leading into a major city during rush hour.
Total gridlock.
Yeah. So we have scaling solutions, or what we call layer 2s.
These are the ones that sit on top, right? Like a second story on a house.
Yes. They sit right on top of the layer 1 to make transactions fast and cheap. Examples would be Optimism, Arbitrum, or Polygon.
I like the highway analogy here. If Ethereum is the busy main highway where everyone is stuck in traffic paying high tolls, the layer 2 is like the express lane built right above it.
That's a perfect analogy. The express lane takes all the traffic, processes it quickly in a big batch, and then every so often it just settles the final data back down to the main highway for security.
And the tokens for these layer 2s, what's their deal?
They're often used for paying those cheaper fees on the express lane or for governance, voting on how that express lane is run. They're derivative of the layer 1, but they capture a ton of user activity.
Okay, so we have the OS and we have the express lanes. What about the actual destinations, the apps themselves?
That's bucket 3. DeFi protocols, or decentralized applications, dApps. These are the programs running on the operating system. We're talking about decentralized exchanges like Uniswap or lending platforms like Aave or Maker.
So these are like the banks and the stock exchanges, but entirely made of code. No tellers, no marble floors, no CEO in a suit.
Exactly. And holding their tokens usually gives you governance rights, so you can vote on changes to the software. But, and this is where it gets really interesting, sometimes holding these tokens gives you revenue sharing.
Like a dividend.
It's exactly like getting a dividend from the bank's profits. If Uniswap charges a fee for every trade, the token holders might vote to distribute some of that fee to themselves. We call this the cash flow bucket for a reason.
Got it. Moving on to bucket 4. This one always seems a bit more niche. Utility and infrastructure.
It is niche, but it's absolutely critical. These are specific service providers. Think of them like Amazon Web Services, AWS, but decentralized. Chainlink is a great example.
What do they do?
Blockchains can't see the outside world. They're in a sealed box. They don't know the price of gold or the weather in London or the score of the Super Bowl. Chainlink provides those data feeds securely.
And the token is just the currency you pay to get that specific service, like putting a token in an arcade machine or a laundromat.
Exactly. It's a utility token in the purest sense of the word. Filecoin offers decentralized file storage. You pay S and F and L to store your files. Render offers GPU computing power for graphics. You pay an R&DR.
So you pay the token, you get the service. If you don't need the service, you generally don't need the token unless you are just speculating on future demand for that service.
You got it.
All right, and finally, bucket 5. The one that gets all the headlines. The one that makes people millionaires overnight and then leaves them broke the next morning.
The Memecoins. Dogecoin, Shiba Inu, Pepe.
Now, usually when I read about a project, they have a white paper explaining their complex technology and their vision for the future. What is the pitch here?
The pitch is that there is no pitch. There's no utility. There's no product. It is pure vibes. It's community. It's humor. It's an internet inside joke that becomes a financial asset.
But people make millions on these. I know people who paid off their mortgage with Dogecoin. That feels pretty real.
They do. They absolutely do. But you have to understand what you are buying. You aren't buying a share in a technology platform. You are buying a speculative gambling chip based on social attention.
So it's all about hype.
All about height. If the attention creates a mania, the price skyrockets. If the attention fades and moves to the next shiny thing, it goes to zero. The risk here is extreme. It is player versus player gambling. It relies entirely on the greater fool theory. You're buying it in the hopes that some other greater fool will buy it from you for more.
So we have the zoo sorted out. We know an elephant from a monkey. Now, I want to circle back to that greed trigger we talked about at the beginning, the idea that a coin is cheap because the price is low. You called this the cheap coin fallacy, and the source material highlights this as the single most common beginner trap.
It is the #1 way new investors get wrecked, without fail. Every single cycle, they look at Bitcoin at, say, $100,000 and think, I missed the boat, it's too expensive, I can't afford a whole Bitcoin.
Yeah, that's a common feeling.
Then they see Ripple XRP at $1 or a Memecoin at 0.00001, and they think, wow, if XRP just goes to $100,000 like Bitcoin, I'll be a billionaire.
It sounds so logical if you don't know the math. It's the same logic people use with penny stocks. Why can't this $1 tech stock go as high as Amazon?
But in crypto, price per unit is completely irrelevant without knowing the supply. You have to look at market cap.
Okay, let's break down the formula, because I think people hear market cap and their eyes glaze over, but it's actually just third-grade multiplication.
It is dead simple. The formula is market cap equals the price of one coin multiplied by the circulating supply. That's just the number of coins that actually exist and are trading in the market. That's it.
Let's run the numbers from our example to show why the XRP to Bitcoin price dream is literally impossible.
Okay, let's do it. So let's say Bitcoin is at a nice round $100,000. There are roughly 20 million Bitcoin in existence right now.
Okay.
So you take $100,000, multiply it by 20 million coins, and you get a market cap of $2 trillion. That's the total value of the entire Bitcoin network. It's roughly comparable to the value of a company like Google or Amazon. It's enormous.
Huge. A massive global asset. Now do XRP at $1.
All right, XRP is trading at $1, but, and this is the key, there are 50 billion XRP coins in circulation.
50 billion with a B.
With a B. So $1 times 50 billion coins is a $50 billion market cap. Still very big, but nowhere near 2 trillion.
So now for the grand finale. For XRP to reach Bitcoin's price per coin, $100,000, what would have to happen to its market cap?
You would have to multiply that 50 billion supply by the target price of $100,000. That would result in a market cap of $5,000 trillion.
5,000
trillion. To put that in context, that is more money than exists on the entire planet Earth.
Wow.
It includes all real estate, all stock markets, all gold, all cash, everything. It is a mathematical impossibility. It cannot happen.
That is a staggering reality check. So when you see a coin trading at fractions of a penny, it's not cheap if there are 500 trillion of them printed.
Exactly. I love this pizza analogy. Imagine a pizza. You can cut a pizza into 4 big slices, or you can cut it into 400 tiny micro slices. If I sell you one of the 400 slices for $1, you aren't getting a cheaper pizza than the guy who's buying a quarter slice for $100.
You're just getting less pizza per slice.
You're just getting less pizza. You have to look at the size of the whole pie, which is the market cap.
So if we ignore the unit price,
Yeah.
which we now know we should, how should we be categorizing these market caps? What's a safe size versus a risky one?
We usually break it down into tiers. Large cap is anything over $10 billion. This is the Apple or Google of crypto, Bitcoin, Ethereum, Solana.
So lower risk, but also lower potential returns from here.
Generally, yeah. Lower risk, lower reward. You probably won't do 100x here, but you also probably won't lose all your money overnight.
And the middle ground.
Mid-cap is the $1 to $10 billion range. This is moderate risk, moderate reward. This is where you find established projects that are still growing and have room to run.
Okay, and then it gets spicy.
Then it gets very spicy. Small cap is 100 million to 1 billion. That's high risk. And anything under 100 million is a micro cap. That is the casino.
The casino.
That is extreme risk. The liquidity is low. The volatility is insane. You can make a fortune or you can get wiped out in an hour.
Okay, so we've established that supply is a critical part of the market cap formula. But the source material dives deeper into this. It turns out supply isn't just one number. When you look up a token on a site like CoinGecko or CoinMarketCap, you see 3 different numbers for supply. This confuses people constantly.
Yes, and understanding the difference between these 3 numbers is where you really start to separate the pros from the amateurs. This is like moving from the front of the nutritional label to reading the fine print.
Okay, what are they?
The 3 numbers are circulating supply, total supply, and max supply.
Let's define them one by one. Circulating supply.
That is the number of tokens currently in the market. The ones that can be bought and sold by you, me, anyone right now. This is the number we use to calculate the current market cap we just talked about. Simple enough. Next, total supply.
That is the total number of tokens that exist right now on the blockchain, including the ones that are locked up and can't be sold yet.
Locked up by who?
Maybe they're held by the founding team or by early investors, or they're set aside in a treasury for future rewards. They exist, but they're not in the public's hands yet.
And the third one? Max supply.
That is the hard limit, the maximum number that will ever exist in the history of the protocol. For Bitcoin, that's 21 million. It will never, ever be 21 million and one. For Ethereum, interestingly, there is no hard cap. It's theoretically infinite, though they manage the issuance rate to keep it low or even deflationary at times.
Now here is where it gets really interesting. Or, frankly, scary. The outline mentions the danger zone related to these numbers, specifically something called FDV.
FDV. This is one of the most important metrics you can learn. It stands for fully diluted valuation.
Fully diluted valuation. If market cap tells you the value of the project today, FDV is like the ghost of Christmas future. It answers the question, what would this project be worth if all the tokens, including the locked ones, were unlocked and put on the market today?
Can you walk us through a scenario of how this traps a beginner? Because I feel like this is where the most sophisticated scams hide in plain sight.
Absolutely. This is the classic low-float, high FDV trap. Imagine a brand new, super hyped project launches. It has a circulating supply of only 1 million tokens. The price at launch is $10. So you do the math. 1 million times $10.
That's a $10 million market cap.
That sounds cheap.
A $10 million market cap for a hype tech project? I'd buy that. I'd think I'm getting in on the ground floor of the next big thing.
Right. It looks like a bargain. But you dig deeper, you check that nutritional label, and you see the total supply is actually 100 million tokens. That means 99% of the total supply is locked up. It's not on the market yet. The FDV is the price, $10, times the total supply of 100 million. That's a $1 billion valuation.
So I think I'm buying a $10 million startup, but I'm actually paying a price per share that values the entire company at $1 billion.
Exactly. You are paying a premium late-stage valuation for a project that just launched. And here's the time bomb. Over the next few years, those 99 million locked tokens are going to unlock. They are going to vest and be given to the early investors and the team. And what are they going to do?
They're going to sell. They got in super early. They want to cash in their profits.
They are going to sell. This floods the market with new supply. It's an avalanche of new tokens hitting the exchanges. And if demand from new buyers doesn't increase by a massive amount to soak up that new supply, the price has to crash. It's simple supply and demand.
So what's the rule of thumb here? How do I spot this?
If you see a project where only 5 or 10% of the tokens are circulating, you need to be extremely careful. You are effectively providing exit liquidity for the venture capitalists who got in before you. You are buying their bags while they cash out.
You're their payday.
You're their payday. You want to see at least 50%, ideally 80 to 90% of tokens already circulating. That means most of the potential selling is already in the past.
That transitions perfectly into the next topic. Distribution. Who actually owns the pie? Because listening to you, it seems like the game is often rigged before it even starts.
In the modern era of crypto launches, it often is. We have two main models for how tokens are distributed at the beginning. Model 1 is the fair launch. This is the Bitcoin standard.
Which means?
It means no special treatment for anyone. Satoshi Nakamoto didn't pre-mine a stash of 1 million Bitcoin for himself before turning on the network. Everyone, including the founder, had to either mine them with computers or buy them on the open market from day one. It is the gold standard for fairness. There was no pre-sale, no venture capital round, no insider allocation.
But that's rare now, right? It's really hard to build a complex project and hire a team without any initial funding.
It's very, very rare now. It's hard to bootstrap a company that way. So now we have Model 2, the ICO or pre-sale model. This is the industry standard.
How does that setup work? Paint the picture of the backroom deal.
So the team creates all the tokens instantly, out of thin air. Then they slice up the pie before the public ever gets a chance to buy. They'll sell, say, 10% to seed investors, the VCs, at 1 penny per token. Then they might sell another chunk to other private investors at 2 or 3 pennies.
Okay.
Then they keep 20% for the team and advisors. And finally, after all of that, they sell a small slice to the public, to you, at the public launch.
But the public isn't buying at 1 penny.
No. The public buys it, say, $1.
So do the math for me. That sounds...
Good. It's brutal. If the VC bought at 1 penny and you buy at $1, the VC is up 100 times on their investment the second that trading begins.
100x. Instantly.
Instantly. Even if the token price crashes by 50% to 50 cents, you have lost half your money, you are panicked. But the VC, they are still up 50 times their initial investment, 50x.
That is just infuriating. It means they have a massive incentive to dump on me, even if the project is failing, in my eyes. To them, a 50x return is a massive success.
Precisely. They are playing a completely different game than you are. They are playing the extract value game. You're playing the hope number goes up game.
Their profit target might be 20x, while yours is just to not lose money.
So how do we protect ourselves from this? Is there a tool?
You have to look at the token allocation chart. It's usually buried in the project's white paper or on their website. You need to become a detective.
And what am I looking for? What are the green flags? Green flags are a high percentage of tokens sold to the community or public, a low percentage, ideally under 20%, allocated to the team and private investors, and crucially, long vesting schedules.
Vesting means the lockup period, right? How long they have to wait before they can sell.
Yes. You want to see their tokens locked for 1 to 4 years. If the team's tokens unlock in 3 months, that's a massive red flag.
Why?
It means they want to cash out and buy a Lamborghini before they've actually built a working product. If they are locked for 4 years, it means they have skin in the game. They are betting their own wealth that they will succeed in the long run.
Okay, so we've looked at supply and distribution. We now know how to spot a potential trap. Now let's talk about the why. Why should a token be worth anything at all? This is the section on value accrual.
This brings us to what I call the utility paradox. Just because a project is popular or has a lot of users does not automatically mean the token itself is valuable. This is a very hard concept for people coming from the stock market to grasp.
Can you give us an analogy for that?
Yeah. Imagine if Twitter, or X, whatever we call it now, issued a Twitter token. And imagine the only thing you could do with that token was change the color of your profile picture from circular to square.
Okay. Twitter has hundreds of millions of users. It's a huge, valuable platform.
Right. But do any of those users need to change their profile picture shape?
No, of course not. It's a silly vanity feature.
It's a vanity feature. So even though the platform is huge, the demand for that specific token is basically zero. The price goes to zero. The value of the company does not accrue to the token holders.
So we need to look for tokens that actually capture the value of the platform. The source material breaks this down into bad and good value accrual. What's an example of bad value accrual that might look good to a beginner?
The most common one is the payment token. A project will say, our token is valuable because you can use it to pay for coffee at our partner shops.
Why is that bad? Isn't that the point of currency, to be used for payment?
Because why would I want to spend a volatile asset that might go up 10% tomorrow to buy a $3 coffee? I'd much rather use a stablecoin or just cash.
And what about the merchant? The coffee shop owner?
They need to pay their rent and their employees in dollars. So if you pay them in coffee coin, they're going to immediately sell it to get dollars. It creates constant selling pressure. It's just unnecessary friction in the system.
And another bad one mentioned is governance only.
Right. Buy our tokens so you can vote on the logo color or vote on which charity we donate to next quarter. The reality is most users simply do not care about voting on minor issues.
I don't even vote in my local elections. I'm not going to vote on a crypto protocol's marketing budget.
Exactly. Governance is really important for huge systemic protocols like Uniswap or MakerDAO, but for a small project, it doesn't drive enough demand to support the price. It's a nice to have, not a must have.
Okay, so what is good value accrual? What actually drives the price up in a sustainable way?
The best and purest example is gas, like we mentioned with Ethereum or Solana. To use the network to send a transaction, you must buy the token to pay the transaction fee. It is mandatory. That creates a baseline of constant buying pressure regardless of market sentiment.
It's like if you had to buy a tiny piece of Apple stock every time you wanted to use your iPhone.
Exactly. That stock would skyrocket. Another great mechanism is buyback and burn. This is where a project uses its profits, its revenue, to buy its own tokens off the open market and then destroy them forever.
That sounds just like a stock buyback in the traditional market.
It is the crypto version of a stock buyback. It reduces the total supply. If demand stays the same and the supply goes down, the price of the remaining tokens has to go up. It makes the token deflationary. BNB is famous for this, burning millions of dollars worth of tokens every single quarter.
And the third one, this seems to be the holy grail right now in DeFi.
Real yield. This is becoming very popular. It's when you stake the token, you lock it up in the protocol, and in return, the protocol pays you a percentage of the actual trading fees generated by the platform.
And they pay you in what? In more of their own token.
Ideally, no. They pay you in something valuable, like ETH, or a dollar stablecoin, like USDC. It's literally a cash dividend. You are getting a share of the actual cash flow. If the exchange makes money, you make money.
That is a crucial distinction. The question you have to ask is, if this protocol becomes the biggest thing in the world, do the token holders get rich or just the founders? You want to own tokens that act like equity or commodities, not just souvenirs.
Yes. If the token doesn't capture value from the success of the platform, it's just a donation to the dev team.
Now, you mentioned yield just now, and that leads us to a very, very tricky trap for new investors, the inflation trap. We see these tokens offering crazy returns. Stake your tokens and get 100% APY, get 1,000% APY.
This is the siren song for greedy investors. It's so tempting. They think, wow, 100% APY. I can double my money in a year risk-free. The bank only gives me 0.5%.
But the math doesn't work like that, does it?
No. You have to ask the critical question, where is that yield coming from? Is the protocol actually generating enough profit to pay everyone 100% interest on their money? 9 times out of 10, the answer is a hard no.
So where does it come from? Magic?
It comes from the printer. They're just printing new tokens out of thin air to pay you your yield. This is just high inflation masquerading as a return.
So let's play that out. If I have 1,000 tokens and the inflation is 100%, next year I have 2,000 tokens. I doubled my tokens. I'm rich.
You doubled your number of tokens, yes. But because the total supply of the token also doubled, the value of each individual token has likely been cut in half, assuming the overall market cap of the project stayed the same.
So I have twice as many tokens, but they're each worth half as much. My profit is 0.
Your net profit is 0. And it's actually worse than that, isn't it? Because all that printing creates constant, massive selling pressure.
Right. Everyone getting those free tokens is probably selling them.
Of course they are. They're selling them to lock in profit. This usually crashes the price faster than the yield can accumulate, so you end up with more tokens, but your total dollar value goes down. You are engaging in a race to the bottom.
I love the catchphrase for this that I read. If the yield looks too good to be true, you are the yield.
That is the golden rule of DeFi. You have to distinguish between real yield, which comes from real revenue and is usually sustainable, maybe in the 5 to 15% range, and fake yield, which just comes from the printing press dilution.
Okay, this has been a lot of theory. It's been fantastic, but let's make it concrete. I want to run through a few case studies to see if we can apply this framework in real time. I'll give you the stats, you give me the verdict.
Let's do it. Put me to the test.
Case study A, we'll call this one the ghost chain. Here are the stats. It has a massive market cap of $5 billion. It's got great marketing. You see its logos all over Formula One cars. But when you look on chain, the total value locked, TVL, in its DeFi ecosystem is only $10 million, and it has about 500 active daily users.
Verdict, the bad. This is a classic zombie chain. It is massively, massively overvalued. A $5 billion valuation with only 500 users and 10 million in TVL means the price is purely propped up by speculation and paid marketing.
So there's no real use.
There is no fundamental usage to support that price. When the marketing budget runs out and the hype dies, this goes to zero, or close to it. It's a bubble waiting to pop.
Okay. Case study B. Let's call this the VC dub stats. It's a cool new tech project doing some revolutionary AI stuff, but only 10% of the total supply is currently circulating.
Red flag number 1.
The FDV, the fully diluted valuation, is $10 billion. And I checked the white paper and see that 50% of the total token supply unlocks next month. Verdict: the ugly stay far, far away. That is a ticking time bomb. It's a dangerous supply shock. You have a massive amount of tokens about to hit the market.
From who?
From the early investors who are going to be sitting on huge life-changing gains and they will want to realize them. Do not buy before that unlock event. Wait for the dust to settle because there will be a lot of selling.
Case study C. The undervalued gem. Stats. Market cap is $200 million. It's a small cap. It's generating $50 million a year in real revenue from platform fees.
Okay, interesting.
That gives it a price-to-earnings PE ratio of 4, and the revenue is paid out directly to token stakers in USDC.
Verdict: the good. This is fundamentally cheap. A PE ratio of 4 is incredible. In the tech stock world, you're lucky to see PE ratios of 20 or 50 or even 100. This project makes real money and gives it directly to the token holders. That is a strong buy signal. That is value investing in crypto.
It's amazing how clear it becomes when you strip away the hype and the logos and the noise and just look at the numbers. It changes the game completely. You stop gambling and you start investing. You start making informed decisions.
So for the listener who is stuck with us and now wants to build a portfolio but doesn't want to get wrecked, how should they structure it? The source material suggests an investment pyramid.
Right. And the key is you don't want to invert the pyramid, which is what most people do. A sane, long-term crypto portfolio should look like this. The base, the core, should be 50 to 70% of your holdings. This is Bitcoin and Ethereum.
Why those two specifically?
They are the index funds of crypto. They have the network effects, the security, the decentralization, the institutional adoption. I mean, BlackRock is buying them. They probably won't do a 100x return overnight from here, but they're also highly unlikely to go to zero. They preserve your capital while giving you exposure to the overall market.
Okay, that's the foundation, the middle layer of the pyramid.
The major alts. Maybe this is 20 to 30% of your portfolio. These are the top layer ones like Solana or blue chip DeFi projects like Chainlink or Uniswap. These are projects that have real users, real product market fit, and have survived at least one bear market. They're battle tested.
And the very tip of the pyramid, the spicy stuff.
The moonshots. Maybe 5 to 10% at most. These are your small caps, your experimental projects, maybe even a meme coin if you really want to have some fun and you understand the risk.
But the key is...
The key, and this is absolutely crucial, is you have to be mentally prepared to lose this money entirely. This is your entertainment budget. This is your trip to Vegas.
The mistake people make is flipping this whole thing upside down.
Exactly. They put 90% of their money into microcap moonshots and meme coins because they want to get rich quick. That is not investing, that is buying lottery tickets. And we all know that most lottery tickets lose.
So what does this all mean for our listener? We've covered a lot of ground today.
It means that while altcoins are the innovation engine of this industry, they are also a minefield, a dangerous, dangerous minefield. But now you have a metal detector.
That metal detector is tokenomics.
It is. You now know that market cap matters infinitely more than unit price. You know that FDV warns you about future inflation and sell pressure. You know to check the token allocation to see if the game is rigged against you from the start. And you know to look for real value, accrue real reasons to hold the token beyond just hype.
It transforms the experience from just hoping and praying that a number on a screen goes up to actually analyzing and making an informed decision.
And that is the only way to survive in this market long term. Speculators get washed out. Investors who do their homework are the ones who stay.
Absolutely. This has been a massive download of information. I think we've equipped people with the tools they need. Next time, on our next deep dive, we are going to take one of those buckets we mentioned, DeFi, and really tear it apart. We're going to talk about how to be your own bank, how lending actually works, and what on earth a liquidity pool is.
That's where the rubber really meets the road. It's complex, but it's where some of the most fascinating innovation is happening.
I can't wait.
Until
then, remember, do your own research, check the nutritional label, check the tokenomics, and don't get dumped on. Thanks for listening to The Deep Dive.
Stay curious.